G. Vilango.
I'm Albert Francis Tumakin.
I'm Jimmy J. Cabral.
I'm Vincent B. Busio.
And we are Group 4. And we are to represent the Consolidated Financial Statement after acquisition.
In this chapter, we are expected to learn the learning objectives. Number 1, describe the accounting treatment required under current GAAP for verifying labels or influence or control by investors.
The second is prepare journal entries on the parent's book to account for investment using the cost method, the partial equity method, and the complete equity method.
Number 3, understand the use of the work paper in preparing consolidated financial statements.
Number 4, prepare a schedule for the computation and allocation of the difference between implied and book values.
Number 5, learning objectives. Prepare the work paper eliminating entries for the year of acquisition and subsequent year for the cost and equity methods.
Number 6, describe how to account for interim acquisition of subsidiary stock at the end of the first year.
Number 7, explain how the consolidated statement of cash flows differs from a single firm's statement of cash flow.
Number 8, understand how the reporting of an acquisition on the consolidated statement of cash flows differs when stock is issued instead of cash payment.
Accounting treatment required under current GAAP. Label no significant influence. Guideline percentage less than 20%. Usual accounting treatment method traditionally referred to as cost method with an adjustment for market change. Significant influence, no control. Guidelines percentage 20% to 50%. Usual accounting treatment, equity method will be used. Effective control, guideline percentage greater than 50%. Usual accounting treatment, recorded under cost, partial equity or complete equity method.
Preparing journal entries. In cost method, journal entries year 1 record the initial and the receipt of dividends from S company. In year 2, we also record the dividends even the S company incurred loss. In year 3, the parent company dividends exceed its share of the cumulative earnings of the subsidiary company. Then the excess dividends are considered a return of the investment and was deducted from the parent company investment, also called as liquidating dividend. In computation, excess dividends are 10,000 multiplied by the 90% dividends limit, then the return investment is 9,000. And remember, net income or net loss of the subsidiary is not recorded when loss method is used. In partial liquidity method, journal entries. The investor adjusts the investment account upward for its share of the investee's earnings and downward for its share for the investee's dividends declared. Goodwill or amortization is not recorded. In computation, the subsidiary income $90,000 is multiplied by the share percentage 90%. Total of $81,000 dividends declared $30,000 multiplied to 90%. Total of $27,000 as well is to the return investment $10,000 multiplied 0.9 equal to 9,000. In complete equity method, journal entries. The entries are the same with the partial equity method. The only difference is that additional adjustments are included for the effects of unrealized intercompany profits, the depreciation or amortization of any differences between market and book values. That's why the equity is subsidiary income recorded for the excess depreciation. In computation, the $50,000 half of underlying equity is divided to 10 years since depreciation is spread over the span of 10 years. That would result in a charged earnings of $5,000 per year. After these entries, posted in different manner by cost, partial equity, and complete equity method, the investment accounts will appear as follows for each method.
Work paper format. On the date of acquisition, the only relevant financial statement is the consolidated balance sheet. But after acquisition, a complete set of consolidated financial statements must be prepared. Income statement, retained earnings statement, balance sheet, and statement of cash flows. There are two working paper formats: the trial balance and the three-section work paper. The three-section work paper will be used throughout this chapter. Accounting work papers are helpful in the accumulating, supplying, and arranging data for the preparation of consolidated financial statements. This includes the three basic financial statements: income statement, retained earnings statement, and balance sheet.
Begin the consolidation process as always by preparing a computation and allocation of the difference between implied and book values. Preparation of schedule for the computation and allocation. The schedule begins with the loss and divides this amount by the percentage acquired to compute the implied value of the subsidiary. Next, the book value of the subsidiary's equity at the date of acquisition is subtracted from the implied value. Then the difference is allocated to adjust the assets and or liabilities of the subsidiary for differences between their book values and fair values. Any remaining excess is labeled as goodwill. Special rules apply for bargain purchase.
Consolidated statement work paper. Prepare the work paper eliminating interest for the year of acquisition and subsequent year. For the cost and equity method, under the cost method, dividend declared by the subsidiary are eliminated against divided income recorded by the parents. The investment account is eliminated against the equity accounts of the subsidiary, and an account is created for the non-controlling interest in equity. The difference between implied and book values is recorded in a separate account. Adjust underlying assets and or liabilities and to record goodwill in some cases. Under the equity method, the divided declared by the subsidiary are eliminated against the investment account as is the equity in subsidiary income in subsequent years.
Interim acquisition of subsidiary stock at the end of the first year. If an investment in the common stock of subsidiary is made during the year rather than on the first day, only the subsidiary revenues, expenses, gains, and losses for the period after acquisition are included in the consolidated income statement.
Consolidated statement work paper. Explain how the consolidated statement of cash flows differs from a single statement of cash flows. In the preparation of a consolidated statement of cash flows, the starting point under the indirect approach should be consolidated net income, including the non-controlling interest. Subsidiary divided payment to non-controlling shareholders represent a financing outflow of cash. Subsidiary divided payments to the parent.
Understand how the reporting of an acquisition on the consolidated statement of cash flows differs when stock is issued rather than cash. Any cash spent or received in the acquisition itself should be reflected in the investment activities section of the consolidated statement of cash flows. The issuance of stock or DIP will appear in the notes to the financial statements as a significant non-cash investment and financing activity.
And that's all. Thank you.